welcome to Finextra. I'm Josie Waite and I'm here at Money2020 Europe in Amsterdam, and joining me now is Leda Glyptis from Qatar National Bank, and we are discussing how banks should be choosing the right partner. Thank you very much for joining me, Leda.
Thank you for having me.
So you talked about banks hedging their bets and still uncertainty on who to partner with and a delay with committing. Why is this?
Well, we have some commitment issues in the industry, it's fair to say. But it's, on one hand, the not committing piece is actually good business. If you look at it from an investment perspective, hedging bets is sound. It's what we've historically done, it's what we're good at, and it's what one should do from an investment and portfolio balancing perspective. So when we look out over the floor here across the industry, we're seeing a lot of banks going down a VC or hybrid VC path, and they look at a space and go, artificial intelligence looks hot, DLT looks hot, we'll throw some money at it. But rather than picking one horse to back, they look at various different flavors. Chances are not all can succeed, but by hedging those bets, you actually maximize your potential return. All of that is as it should be. It's frustrating from the point of view of the startup, but it's actually a good practice on the bank side. What isn't a good idea on the bank side is doing the same when it comes to their own transformation. And I think we're reaching an industry pivotal moment now where having 10 parallel pilots testing different flavors of the same technology is no longer viable, either financially or in terms of actually giving you the epiphany that we're all kind of waiting for. This is a time to actually make some commitments and say, I personally believe the future of banking and my future in it looks like this, and therefore I'm going to stop hedging from an infrastructure transformation perspective, continue hedging from an investment perspective, and make some hard commitments, which entails risk. And the reason any organization is holding back is because that risk is a danger to your current profitability, to your current stakeholders, to the people whose pension is with you. It's a difficult decision to make, and I think we will continue seeing banks making those choices as gradually as possible and as carefully as possible, which is actually the most responsible thing to be doing, given the duty of care they have to all of their stakeholders, and I don't just mean shareholders, I mean their customers.
What are the problems you're seeing with regards to making money? You mentioned in your keynote yesterday you need to pick a partner that will help you with revenue. What does this entail?
I'm increasingly becoming very wary of people using terms like ecosystem and partnership because they often conceal the fact that innovation as a corporate activity is meant to give you a competitive edge. It's not a playground, even though we tend to be much more playful within this space. That's because we're learning, that's because we're experimenting, and you lose the arrogance of knowledge when you're actually trying to work the answer out. But that should not be mistaken for a space of high inclusion. Innovation is meant to be a highly competitive space. And the danger we're seeing, well, the danger I'm seeing, is that a lot of the partnership we're seeing, a lot of the ecosystem activity we're seeing is an extension of the hedging of the bets. But the hard conversation of monetization isn't being had. If we strip this down, this entire literal circus down to basics, we are here because over the last few years, banking players realize the world is changing. Technology has come in, the way we used to make money will no longer be as profitable, the numbers of players will no longer be necessary, and quite a lot of the activity we used to do, particularly at the back end, will be replaced by automation. All of that is dangerous because you don't want to be the one who gets eliminated, and also potentially a loss of profitability. So we entered the fray to make sure that we're the ones who survive and to make sure we're the ones who win. But then we stopped having those conversations, and you see a lot of partnerships where the startup is essentially undercutting the price point of the bank or advocating a different coalition of forces. And yet those partnerships are taking place as a learning exercise, but you know from the get-go that this can't work for both parties. And take a step back and say, you're not the right partner for either. Years ago, I had this startup call me up and said, this activity, without giving the game away, that you hold 70% of the market for, I have a solution to completely eliminate the need for it. Do you want to partner with me? Like, no, I really don't want to partner with you. I can see what you're offering. I can see that I should understand it, but no, I'm not going to help you bring it to market. And there's no shame in that, and we need more of those conversations, because at the end of the day, this is business. We're here to make money, to generate value. It's highly competitive, it's always been competitive, and to pretend like somehow we will all come out of this unscathed is not helping either the traditional players or the startups who are actually sort of kept in a game that might not be viable.
There's lots of talk about the new products and services the banking industry can offer. But what should banks be doing with their technology to make value to the customer?
That's a very, very interesting question, and one that is not necessarily talked about the way I would personally like to see it talked about, because it is an extension of the value and monetization conversation. At the end of the day, if you decide what animal you're going to be in this changing ecosystem and what it is you will be doing for the customers, which translates into what the customer will be willing to pay you for, then the question is not what's the art of the possible. The question is, what do you need to be doing to still be getting paid? It's that simple. So the technology you should be investing in is the technology that helps you along that path. And that laser focus is something that will answer the question of build or buy. It will answer the question of which partners you should choose. And it's not just who is kind of facing the same direction as you, but it's also who's not competing on your value add. We have historically had a mentality of, not built here syndrome within banks. We transitioned away from that to being perfectly comfortable white labeling and using partnerships and third parties. But we are actually coming into another inflection point where you're saying, okay, if the customer is becoming increasingly knowledgeable and demanding, and the proliferation of services is giving them choice in an unprecedented degree, how do I differentiate myself? As a bank, as a startup, as a third-party provider, that conversation is a business model conversation that needs to take place within your organization and needs to be taking place repeatedly. That conversation drives the answer of where do you invest? Because the technology that is auxiliary and ancillary to that purpose, you bring partners in, you white label. The technology that is key to delivering that value, that will be the thing that the customer pays you for, that's who you are. And it is baffling to see so many organizations behind us on the floor and across the industry not actually resolving that question before they go into partnerships. And then you create tensions that get either resolved with takeovers or don't get resolved. And sometimes the customer pays, sometimes they actually slow down the innovation path, and these companies will get overtaken by someone who actually worked out their business model first.
That's been really interesting. Thank you so much for speaking with me.
Thank you very much for having me.
And thank you for watching.